Hello, everyone. Welcome to the stock specific class here for Thursday, December the 1st. Can't believe that November is over. We went through November pretty quick. Now, if you have any questions during the week or any questions I don't get to today in the live class, make sure you send those to jerry@traderspro.com, and I'll be happy to answer those for you. Also, if you happen to miss a class, you can catch up with it on the recording. You go to YouTube and find our YouTube channel, TradersPro. You'll see recordings of these classes. And that goes with also if you miss something in class, you're attending the live class, you miss something, you want to go back and review it again, you can do so through that YouTube channel. All right. Lots happened since Tuesday. Again, it seems like every week we whipsaw back and forth. We're looking like we're going up one day and looking like we're going down the next, and that's the way it's been for a couple months now, and it's been a little frustrating. These are not whipsawing markets. What I always hate about whipsawing markets is you work twice as hard for half as much money. If you make money. I mean, a lot of times you don't even make money. But I think it's important that you understand that's part of trading. We get so obsessed sometimes with trying to find the right guru to follow, the right software to use, the right training program to learn how to trade, that we forget sometimes that the market doesn't always pay you when you want to get paid, and there are times you just have to suffer through it. For the last 2 months, I mean, it's been a pretty crappy market to try to trade, and it's that way whether you're bullish or bearish, or like us, where we've been both bullish and bearish, depending on the week and the day, and sometimes the hour. But I think it's an important lesson to bring up, that you have to accept that, and you have to almost kind of laugh it off, or just, you just realize that we're all in the same boat. We're all part of the trading crowd. And it can be frustrating because sometimes you see someone that gets lucky in those conditions, and, they have 4 or 5 trades that they hit right on and they made a ton of money, and they're bragging to everybody. And so you have a tendency to think that, man, maybe I should follow what they're doing because they probably figured it out. No, they got lucky in a crappy market condition. Don't overreact. Don't change your whole philosophy and your whole trading system over something like that. Just recognize that, okay, you may not make a ton until it changes. Now, when the market does start trending, and I always say whether it's trending up or trending down, I don't care. I can make money either way. This software is designed to be more of a bullish bull market type software. So we would prefer a bull market in using the software here. But if you know how to trade both ways, and part of the one of the things I've tried to introduce during this bear market is being able to use some of these inverse ETFs to make money when markets go down. But I think that's important to learn. So it's another tool that you can use. But just realize that we're not going to be in these conditions for very long. You usually don't stay in these whipsawing conditions for very long. But they happen. They happen all the time. As far as, within a year, you're gonna get usually a couple months within every year where the conditions aren't ideal. You just never know when they're going to be and when they're going to end. And that's why you have to just keep trading. And it's easy to say, well, I'm going to sit out the market. I've heard people say this. I'm going to sit out the market until the conditions get better. And I've said it myself before. But the reality is you don't know when it's going to get out of it. Usually when it gets out of it is when you have your most prosperous period. So if you wait and see, like a day like yesterday, and you're like, oh man, that is, that's the start. If you missed yesterday, you may not get that again, or it may not last that much longer. You missed the big move. So you got to be in the market all the time to capture when it does start to go. But just, I think that's an important thing to realize, is that the market's not always going to pay you when you want to get paid. And you just, the key is to be skillful and to be patient, so that you can be there and be ready for when it does. And you'll see it when we get into more ideal conditions, and particularly in this class where we're supposed to be going over a lot of different trades. There'll be a lot. I mean, it's funny because, you know, we have been going over a lot of trades in this class for most of the year, and it should be that way. We're in a bear market. There aren't going to be many. We don't want to be in many trades. And so, but I'm telling you, it is just the opposite. When we get back into those bull market conditions, we're going to have this Thursday class, and I'm going to do probably a 10-minute market update, just to quickly review what we talked about on Tuesday to make sure the conditions are still ideal. Or maybe we need to be, you know, maybe we might have to wait. There could be a little bit of a pullback within the uptrend. I'll do like a 10-minute market update, and then the rest of the time we're going over trades, and we're going over patterns and things we like, and we're adding to the portfolio and taking profits out of the portfolio, you know, off the trades in the portfolio. So, you know, I know some of you are just joining right now, and actually it's a good thing if you're just joining right now, because this is also an ideal period of time to learn things, learn how to trade while the conditions aren't great. So when they do become great, you're ready to capitalize on it. You're not starting your learning process at that point. And so learn how to, you know, how to read a chart. That's what I try to show you here. And when we analyze the markets, how to read price action, those candles. We talk a lot about that. And by the way, again, if you're not aware of it, go to that YouTube channel. There's hours and hours of training videos on just about everything I talk about in these classes, or teach chart patterns, Fibonacci retracements, Elliott wave, all kinds of stuff in there. So, all right, direction alerts, still in a bear market. I talked on Tuesday about watching these indicators are getting a little bit more extreme. The momentum indicator, though, is really lagging. And so we have a market that is going higher, but it's not going higher with strong momentum. And that's been a little bit worrisome for me. It falls into what I was talking about on Tuesday about the choppiness of the rally, looking more corrective for another move down than you know, starting a new trend up. Except for the Dow, the other indexes. The Dow looks like it had a strong move off those lows. There's no doubt about that. But it's not supposed to be leading, and that's been another big problem that we've been encountering during this whole move. It should be the tech stocks and the small caps that are leading the trend. You'd want to see that for a healthy trend, at least. Breadth indicator is getting extreme and moving a little bit more to the right side of that box. That means there have been a lot of stocks that have been participating in the rally. It hasn't just been, you know, tech stocks or big cap tech or the largest companies. There's been a lot of participation. In fact, you look at the Russell 2000. There's been a lot of Russell 2000 stocks that have started to take off a little bit on some of these rally moves. But we're getting extreme. Sentiment is right on the far right side of that, and we're going to check that VIX indicator again, because that VIX indicator is back down to that 20 level. And so, in other words, what makes that significant is that, you know, the market just had a big day yesterday, but it had a big day in an area where we're getting extreme. We're getting overbought, and so it could keep going. It could stay overbought for a long time. It's not an overbought condition is not an exact indicator of what the market's going to do the next day or the next week. It can stay overbought for a while, but you just have to recognize that move. It's in an extreme level. So if we start seeing bearish reversal candles or sluggish price action then we don't want to be buying into that in this condition. We want to be cautious. We either want to be on the sidelines, or we want to be possibly in inverse ETFs or something like that, or just resist adding too many new positions in this type of condition right here. What we've seen when the VIX has been getting down to 20 is we've been seeing these bigger sell-offs take place. And since we are still in that bear market, we still have to respect that this could be a rally within the downtrend until this all kind of changes. And I know the Chairman Powell speech yesterday was optimistic for the market, looked at it as optimistic. That's another thing too, is I talked about this on Tuesday with these news events. We're not trying to figure out whether his speech was positive for the market or negative for the market. If you listen to the speech, you heard both. I heard both. Things that you could grab onto and say, hey, that's he's pretty much saying things are still bad. And there were things in there that you say, hey, maybe things are getting better to where we're not going to have these, or we're going to slow down these rate hikes or what have you. But if you're trying to figure out and guess what the market reaction was going to be to that, it's almost impossible. So we do the opposite. We wait, let him have his speech. In fact, I didn't listen to the whole thing. I listened to just little segments of it. He's a pretty boring speaker. Most Fed chairmen are, because they don't want to tip anything. They're not very emotional speakers. And so they tend to be, they can put you, I mean, that's what you want to put on when you want to take a nap, is to put you to sleep. But obviously, okay, so the market rallied off of that news. So that was the reaction. The market liked, thought whatever he said yesterday was more bullish. Now, the question though is it longer term bullish, or is that just a short term move? Because what we saw in the after that CPI report was it made a big reaction to it, and then it just stalled out. In fact, I'll talk about that when we get to the chart there. Let's get through these direction alerts here. Buy sell ratios, again, they're not showing any sort of extreme. A little bit of an uptick from yesterday's move from the new buys exceeding the sells. Sentiment is still high, but still off that extreme. Could get there very quickly though if the market pushed a little bit higher right here. So that's one thing to be aware of. Let's get to the chart. So, and what I was talking about was back in here. We had that CPI report that came out. Remember, the market closed down here the next day. So if I were to draw a candle, ignoring the gap up all the way to the high, here's where we closed up here. Look how massive that candle would be. And it looks a little bit smaller than what we had yesterday. Yesterday, the news event, the speech happened during market hours. The CPI report came out before the market opened, and that's what caused that big gap up. But you had that massive move, and then it went higher the next day, and then nowhere. Until yesterday, we went nowhere for 2 weeks. Whipsaw back and forth. So if you want to say, okay, this is it, this is the one that's going to launch the market even higher. Well, let's see. One thing, I think this tomorrow's jobs report could be important. We're not going to hear anything from the Fed. They're in a quiet period until their Fed meeting on the 14th, which is a week from next Wednesday. And then you've got this OPEC meeting on Sunday that if oil prices start going up, if they're not going to increase production or not increase production enough to keep prices down, oil prices are going to go up, and that's going to be, I think that's going to be tough in the market. We're already dealing with inflation. What helped us a little bit, if you notice, and maybe you notice this on a very personal level with your own spending, but I've been less stressed about gas prices in the last couple of months as they've kind of come down a little bit. If they spike right back up again, that's just another concern, and it's another drain on the monthly budget, and it's I think that's problematic. especially when we're in this big retail month, if things start to, if gas prices start taking off, that's less money that people are going to spend for the holidays, and then it kind of spirals from there. The bond market's already signaling a recession. And people are, that's the debate right now is, okay, is the bond market right or is the market right? The market isn't signaling a recession. It's signaling that things are going to just get better from here. Now, historically, the bond market usually tends to be more accurate because bond traders tend to be more seasoned traders, more experienced traders. Now, that's debatable, but there's some reality to that. I don't find too many people that start off trading the bond market. They almost always start off in equities. Then they might move on to options or futures, and then maybe they end up trading bonds. But not too many people trade bonds. So they do tend to forecast a little bit better than the average trader. All right, now on this chart too, let's back out because we talked about something on Tuesday, that trend line, and we hit it exactly with yesterday's rally. We closed exactly on that trend line. I'm not going to be able to draw a real straight line here, but trust me, we closed exactly on it, and that's not bad for having to free draw. We closed exactly on it. We moved a little bit above it today, but with the market reversing, remember it was up early and then it reversed. We're right at it again. So this is what I'm saying. It'll be interesting to see what that. Now I'm just not that we have to be obsessed with these news events, but here we're at a key resistance level. We're having a bearish reversal today, and we've got a jobs report that comes out tomorrow. Again, it's either going to push us above that trend line or it's going to start dropping us. And we've got an event that we can see that might push it one way or the other. Now, a couple of things I talked about over the last couple of weeks was, one of the theories I had was because so many people were watching this, and this trend line, the 200-day moving average is right below that trend line as well. A lot of traders look at professional traders or algorithmic traders will use that 200-day moving average in their decisions. That I felt like, well, maybe since so many people are watching that area, that we could either reverse before it, and that's what I thought was happening early this week. On Monday, we had the drop down. Or that we could push a little bit above it, start breaking out where it looked like, here we go, we're breaking this trend line. Everyone would start turning more bullish at that point, and then it would reverse. I think that's still in play here, because although today is a bearish reversal candle, it also looks a little bit more like a pause. It doesn't look, at least not yet. Obviously, we've still got an hour and a half before the market closes, but it looks like it could just be a pause for either another move up or start another move down. You don't base it when you get an indecision day candle. You don't want to make a big bet on a direction off of that, because it's all it's telling you is I could go either way, and I either could continue the move or I could reverse the move, the trend, and so obviously you need confirmation for that before you jump in. But I still think we could push a little bit higher. But keep in mind, what does that mean? We're already at an extreme. We're already at where sentiment is already too high, too complacent. And so when you break out, and not only that, but market breadth is in that extreme already. Market momentum is lagging, which usually it should be leading. And so even if we do break out right there, I think it's prime. It's in a prime situation for a reversal after that, a breakout, making it a false breakout. So we'll be careful. Now, what would cause me to turn more bullish? I mean, I don't want to just, I do have a very bearish outlook for a number of reasons. But believing that we could still have more downside. But what would cause me to kind of force me to turn more bullish? Well, obviously, if we could break out, we've had these lower highs through here during this whole downward move, and we've had lower lows. That's consistent with the downtrend. That's how a downtrend acts. Now, here was the last lower low. So when you have the last lower low, you look at the previous lower high before that lower low. So this was the previous lower high before that, before that lower low. If we break out above there, that would be a significant reversal. Now, the Dow has already done that. And that's been the argument: is the Dow, are the rest of the index going to catch up to the Dow, or is the Dow going to, if we reverse down, is the Dow going to start following the NASDAQ down, following the Russell 2000 down, following the S&P 500 down? Now, again, I get back to, and I know I repeat this a lot, but I always have new people that come in, so I kind of have to balance that a little bit. Typically, not always, but typically, the Russell 2000 and the NASDAQ 100 lead. So it would make a lot more sense to me that we have another downturn and they are leading the way down, and then the Dow starts to follow. But again, it doesn't always work out. It doesn't always play out that way. And so for me, what would force me to turn more bullish, I've got to turn more bullish, is if the S&P could break above here, because now the Dow's already done it, but none of the other indexes have done it. And now, the next broad index, the S&P 500, if it does it, then I've got to kind of force myself to turn a little bit more bullish in that situation. I also get back to the fact that on these sell-offs, we never had panic selling. I mean, we never had the VIX spike up above 40. We've never had a major market bottom, financial collapse of 2008, internet bubble 2000. This is the next big correction. You kind of discount the COVID because it went down and up so fast. We've never seen that in the history of the market. So that was an outlier. But even then, there was panic selling. There was major panic selling. That was some of the highest panic selling readings we've ever seen on the VIX. Because talk about uncertainty, and when you're shutting the whole economy down for 2 weeks or longer, it was even longer for a lot of the businesses. I mean, there were just a lot of unknowns there, but we have not had a panic sell-off, and this has been a major decline. And so could this be the one time where it doesn't? Yeah, it always can be that way in the markets, but man, it's hard for me to buy into that yet, that it's not going to happen. But again, I'm going to have to force myself to if we start acting more like an uptrend. I can also see, again, the choppiness of this rally here that's concerned me. It just looks sluggish. Even this move looked a little bit more impulsive. And actually, I had near the top of this, I was leaning more towards turning a little bit more bullish. And then we got that decline. I feel like the same thing's about to happen right here. And this is even more sluggish than it looked back in here. Go back to a 6-month chart. Yeah, so we have a bearish reversal today. How do I know it's a bearish reversal? Okay, we opened higher. And here's where we closed yesterday. We opened higher. We couldn't push any higher. We tried to push a little bit higher, but we couldn't. We're now trading lower than where we opened, and now lower than where we closed the day before. But with the intraday high up here and the intraday low down here, it's not quite a spinning top, which is a real indecisive day, but it's pretty close. It's a very compact day. But it's in an area here, especially when you add that trend line in, it's in an area where it could just be a pause after that huge day to where then it goes higher, or, you get a little bit of a reversal there. So try to see if I can show examples of both. Let's see. Yeah, there haven't been many big up days where it's paused and then, well, here was a little bit of a bear. This is a little bit of not quite an indecision day, but here's a little bit of a bearish reversal candle that didn't reverse. Here's where we closed the day before. We gapped up. We opened up here. We closed down here, right where we opened or closed the day before, and then it pushed higher. But there again, it just barely pushed higher and then dropped. I can see the same thing happening here, where maybe it does push a little bit higher off that jobs report, maybe not, but it starts to decline and decline sharply. By the way, I started to take defensive action in the portfolio. I had to get out of some positions early because some of them were dropping quickly. But I'll go over that in just a second. We'll go over and take a look at that here. But I am mostly in cash in the portfolio, and probably will continue to be for a few more, for at least into through next, maybe even through next week. All right. The Dow, the Dow has been, this is clearly looks like a strong uptrend through here. It doesn't look corrective. If we back out to a 2-year chart, see, this is what I was talking about. It did break above that previous lower high, but it barely broke out about, and then we have this bearish reversal candle today that's brought it right back down. See that breakout. So here was the breakout right here. And then we're right back to the breakout levels. And look kind of where we're at right now. We're like right at this high right here. I can't draw a straight line, but there again, it's not telling me. This could just be a pause. It happens all the time where you break out, then you come back and retest the breakout. You break out, come back. What used to be the ceiling now becomes the floor, and then you can rally off of that. So what I'm trying to say is that we're at a kind of a critical area right here. That it can go either way right here, but this is a significant spot. We want to really pay attention to what it does right here, and not just in one day, but probably between now and Tuesday's market update class, we're going to have a better idea of whether if the breakout has some legs to it, or we're starting to look like we're reversing it. And from where we're at right now, I really believe that if we're going to get a drop, it's going to happen between now and the end of next week. Because if you go beyond that, if we move sideways for the next week, that would be more bullish. Because whenever you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. If it has another move higher and then reverses, we're going to see that. We should see that within by the end of next week, because it should happen pretty quickly. Or if we start dropping significantly, obviously we'd see that happen by the end of next week. So I really think that's why I said this is a critical spot. I think what happens over the next week is going to tell us a lot. It's going to tell us probably whether we're more likely to rally into the end of the year or not. Now, this gets into another area that I don't want to go back that far in the chart, take a little bit too much time, but there's a tendency, and it's warranted, because it is true that December tends to be a very bullish month. And you're starting to hear people talk about the Santa Claus rally, and they're hearing a lot of people talk about the expectations the market will rally into the end of the year. I remember back in 2018, the same thing happened. The market was kind of going sideways a little bit in November, and people were saying we're going to rally to the end of the year. December is always bullish. And then I'm going off my own experience, where not that December has always gone up, but one thing that I at that time, one of the things that I had always relied on was we never had big sell-offs in December. We had minor pullbacks, as you do within any trend and within any month. But I never really remembered a big sell-off in December. Well, that year we had a big sell-off, not a big panic sell-off, but it was a pretty big sell-off in December, and it threw everybody off. And I think that's part of what fueled the selling that month, was people thinking, this can't happen in December, and it did. And I kind of feel like things are setting up again this year to do the same thing. That I think I've been feeling more like we're gonna sell off into the end of the year. Now, again, we'll see what the chart does. But like I said, I really think that within this next week, obviously we only have, 4 or 5 weeks in December. So, if we're talking about, are we more likely to rally through the end of the year or pull back? Like I said, I think this next week is going to tell us. And I'm leaning more towards the sell. And like I said, I could probably go on for hours, because I've been doing a lot of technical and a little bit of fundamental research and sentiment research. Like I said, you try to read crowd behavior, and the crowd is getting too bullish. The crowd is too bullish. The market is too bullish with an economy it's signaling it's going into a recession. And this is part of what I think this is part of what Chairman Powell, what happened yesterday is exactly what Chairman Powell is worried about. He wants to be able to come out and say, yeah, it makes sense that at some point we'll start slowing down. We are seeing more positive numbers in inflation. But he also knows the market's going to take that and just start blasting high, or could start blasting higher because of it. And then what's that going to happen? It's going to cause inflation to come back again. And that's the thing, is he's got to choke it off. And the only way to choke it off is to put us in recession. I mean, it really is the only way to do it. At least in my mind, that's the only way I see it. If people talk about a soft landing, they've never had a soft landing, ever. And could it be the one time they get it and do it right? Yeah, it could. But I think human nature prevents them from doing that, because if they could take what Chairman Powell said and not get too crazy with that information, then there could be a soft landing. But that's not human nature. We're not going. We want to be the first ones to buy, and the first ones, and we don't want to. We're going to chase the move if we feel like we're getting behind it. And so we've got to get to a point where nobody wants to buy. And that's at a bottom, and that's not what the market feeling is right now. Just take Bitcoin, for instance. Bitcoin is actually showing you the signs of what a bottom feels like. How many of you really feel confident? Well, some of you might, but really feel confident running out and buying crypto right now, especially with the FTX collapse. You're like, man, I don't want to. Maybe I'll dabble in it, put a little bit in it. But how many of you, after seeing that story, want to put your whole life savings in crypto right now? Well, that's how a bottom feels like. You don't feel confident in the buying, and we just haven't hit that yet. Sorry, I'm going really long on the update part again. So now the Qs, this would be the argument, although this is a real indecision candle right here. But this would be an argument why I could easily see we go a little bit higher, is that we're still right at this high right here. So this is a real sideways move. Whenever you have a sideways move, when I say that whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. That doesn't always mean it's going to make a big move out of that. It could just break out, and maybe it did. Maybe that is what you call today's high, was it did break out of that. Although usually I'd like to see it close on a breakout there, and that could be it. That could have gone higher. It continued in the direction it was moving in before it moved sideways. It would fulfill that rule of thumb. But because this is an indecision day, maybe it has that one more push where it looks more clear that it broke out, and then it could be free to go down. But you can see again how much this looks more really choppy and lagging, sluggish. We're nowhere near. Here's that previous high that we're looking on the Dow. We're nowhere near that one. and it's just way lagging. Same with the Russell 2000. Same thing here too, though. This one hasn't even really broken out above there, and maybe it has one more update. But here's that high. This is the high that the Dow has broken above, barely, and you can see how far these have lagged. Bond market is trending up now. But the yield curve is inverted, and now doesn't always mean that when the yield curve inverts it leads to a recession. But when you throw in everything else into the equation, the inflation problem we have, again, I don't see how this is not going to lead to a recession. I think this is the one time you can say that inverted yield curve is almost guaranteed to lead to a recession. But bonds are moving higher today. Gold. What I talked about I think it's the last couple of updates I talked about gold. We had a big jump in gold today. A lot of that was the big drop in the dollar. We were going to look at some gold mining stocks. We can still look at some of those today. I forgot I was going to point out a couple of them. Part of the problem was that I guess gold would be for a longer term trade. You want to stay in it for a while and ride it through these whipsaws these correction back and forth. I think this is a good time to, particularly the gold mining stocks. The reason why the gold mining stocks are lagging the chart of gold a little bit is because the gold mining stocks need the price of gold to be at a certain level where they start making money. I can't remember what that level is. I'm gonna have to research that because it's been forever since I've traded gold. I've kind of stayed away from it, as you know. But once gold hits that level, these gold mining companies are going to take off. They're really talk about a bottoming. Stocks that have bottomed or look like they've bottomed. They've been forming a base for quite a while, and I think they're going to start taking off. And I made the argument on Tuesday about that too, where people are going to go to gold because they're going to be scared about the value of their money, and they haven't been yet, and that's why gold has lagged even in this inflationary environment. Oil's been jumping again. Sunday, I think it's Sunday. I'm pretty sure it's Sunday. Is that OPEC meeting? What I want to see on oil is I want to see this low hold. I talked about this on Tuesday. I was concerned that we broke this support level, but we had a bullish reversal candle here, and we've moved higher since then, and that's a higher low so far. But if we break below this low, we're more likely to break below this low, and I'd be turning a lot more bearish on oil at that point. But I'd wait for that meeting because if oil's down enough to where if oil is going to go higher off of that meeting, you're still going to be able to participate in the rally. But it could drop very sharply if they're going to have huge increases in supply. And again, I don't know what the oil condition is, and you don't need to. We'll just wait to see what the chart does. But I don't know if I'd want to be loading up ahead of a binary event like that where it really could go either way, especially with the chart that's showing it still could go either way, and it's been going either way for the last few months or so. The dollar, big drop today in the dollar, continuing this downtrend, and that's what's causing commodity prices to go up too. Now it's starting to get stretched a little bit. This is one thing to pay attention to. We're starting to see we're getting into that extreme we're close to getting into that extreme reversal risk. Doesn't mean that the dollar would suddenly start trending up, but it could mean that it goes into a little bit bigger correction, maybe move sideways for a while or something like that to alleviate that oversold condition. And that's pretty much what it did right into here. It backed off of that. It got a little oversold right here, and then it backed off of it. It didn't go up much, but it moved sideways, and it alleviated that oversold condition. Now the market has been, I think it's important to watch this too. The market has been moving more in line with what the dollar's been doing. By the way, I've eliminated the HYG, the high yield corporate bonds. I'm not hearing a lot of talk about the high yield corporate bonds that I did before. Like I said, I'm going to, if I hear the market focusing on something, I'll add that into the update. But I don't want these updates to be too long. They're already long enough. And so I got to cut back a little bit, but the market is focused on the dollar, and it is moving along with the dollar. Inversely, when the dollar has dropped, the market has rallied. Although today you could make the argument it's a little bit of a divergence. The dollar's down big, and the market is well, it's a little bit mixed. Dow down, Nasdaq up, but that is interesting, because if we do start to see the dollar, if the dollar does start to rally from here or starts to move up, maybe that could be one of the reasons why the market starts selling off as well. So if the market is moving up with the dollar going down, and in other words, what I'm trying to say is that there's not much more room for it to go up before you start getting, for the market to go up and the dollar to go down before you get in this extreme area here where you would expect a potential reversal, it'd be in danger of a reversal. So this also leans more towards my argument that we could be getting closer to a market sell-off here too. And by the way, that's all it is. The nice thing about trading is that there's a lot of, there's room for a lot of opinions and interpretations. Now there are times where it's clear, for me to pull up a chart of the Dow and say that this is a corrective move, this is clearly a corrective move and clearly a sign that we're going to go lower. I don't know any technical trader that would back me on that. That is not a sound argument. There's nothing in that is showing weakness at all. But you get into these other areas where you can have, I can look at the reason why I'm talking about this is even with our trading group, we have there's different opinions within the company, and I respect all the traders here, and I've known them a long time, and there are times when they're right and I'm wrong, and times where I'm right and they're wrong, and usually it comes down to these kind of gray areas where we could have mixed opinions. Could this be a base? Could we look at? Let's look at the Qs, because that's the big divergence here. Could this be still just a basing process where we start heading higher, and we're gonna end up just trending up? We are reaching higher highs and higher lows. That is acting like an uptrend, and so I could be bullish on this and give you all the reasons why I think the markets could go up from here, and I can have a differing opinion on that. But you don't want to. But I would argue that anyone in the company that is talking about at least approaching this technically, if we were to break below these lows right here to where now you have a higher low, higher high, and then now we have a lower low, and this is looking corrective of this move down right here. A breakdown below here, I think most technical traders would start to turn a little bit more bearish with that type of a move. So I just wanted to make that clear, because sometimes sometimes when I start to form some opinions that I get pushback, which is fine. I'm open to pushback. The only thing I ask is that you defend your argument. You don't just say, "Oh, I think you're wrong, and the market's going to go up." Okay, well, what are your reasons for believing it's going to go up? And make sure you do it before it happens. Because the other thing I have a real pet peeve on is when somebody waits until a move happens where I happen to be wrong, and then sends me an email and says, "Oh, I knew it was going to go that way, and I knew you were wrong on that call." That's like waiting till the end of the football game and saying, "I knew that team was going to win." Well, no, call your shot before give me your reasons before the end of the game. They don't have respect for you, but don't wait till after and then criticize me. I don't have any patience for that. So, all right, the VIX. Now, what's interesting on the VIX, I'm going to go to the VIX chart here like I've been doing, where we can see the actual VIX. Again, we're right down here to 20. This has been the area where we've seen market sell-offs happen. Now, it hasn't always been exact, and this is what I pointed out on Tuesday. I'll point out again here. Here we were right around 20 for a week and a half before the market sold off, and we dipped below 20. Back here, we dipped well below 20. We got down to 18 before the market sold off, okay? So we're not saying, hey, because we're at 20, this is exactly where the market's going to sell off. But again, you combine this with that trend line I showed you, all that other stuff I showed you, and we're at a VIX down at 20, and you're saying, oh boy, these things are really adding up to a condition for a market sell-off. The only thing, the thing I would point out today, though, is, well, the S&P is, okay, the S&P is basically flat. But we have an S&P that's flat and a VIX that's down. Now, the VIX and the S&P should be moving inversely. It's clearly down. It's down almost 2%. A little bit of what that's showing me is there's a little bit of, there's not a lot of worry in the fact today that the S&P is flat or down a little bit. It's been bouncing back and forth. Now, again, the Dow is down, but if we don't want to compare the VIX to the Dow, we want to compare it to the SPY or the S&P. NASDAQ is up a little bit. We got a little bit of a mixed market. But this would be actually understandable that we had a big day yesterday. There shouldn't be concern that we're not down big today. It does kind of feel like a pause, like I've been talking about all day. So we'll have to see how it moves, how everything moves over the next couple of days or so. Chip stocks. Let me bounce over here to. And by the way, I'm not going to spend much time on Bitcoin. I'm not going to eliminate it from the list. But I'm not. I'll probably only cover that on Tuesdays. I don't see the need to cover some of these in depth twice a week just yet. If it starts trending up strongly and everyone starts getting back into crypto again, we'll put a little bit more emphasis on it. But suffice to say, it's in a bottoming. It could be in a bottoming process, or it could still be going lower. Just because it's acting like a bottom doesn't mean it's at the bottom. You can still have some moves lower in those conditions. All right, let's get to the portfolio here because I told you I made some changes. You can see I'm mostly in cash. I have 111,000 in cash now. What I got out of was, I had to get out this morning. I'm going to get out of another one today, but I felt like I could wait till class to get out of this one. But CEIX had a big reversal. And then we were already, remember, I was already talking about getting out of this. We were in that extreme reversal risk. We were bumping up against this area of resistance. This was Tuesday's class. I held it yesterday. In fact, I thought about getting out of it yesterday because we were right at it. But the market had such a big update. I thought, well, let's see if there's some follow through today. And then we had this reversal candle. So I got out of that early. But again, I can jump back in it again if it comes rebounding back and breaks out of this area. If it breaks out of here, I'd want to probably be back in it again. So I just felt like market's looking a little bit more bearish. I don't know what's going to happen. I wanted to lighten up on oil. Remember on Tuesday when I told you, I don't want to be so heavily in oil going into this OPEC meeting. And so I kind of lightened up a little bit. I also got out of ADN. It had a big reversal today too. And again, as soon as it was starting to break down below yesterday's open right here, that was looking bad. I went ahead and got out. So I caught it before it got all the way down here. But that's why I had to do it before class. It just felt like it was moving too quick to wait. And I'm glad I did, because it would have been a bigger drop. And on that one, I don't think I made very much on that one either. The CEIX trade I made a decent amount, but these other ones, it wasn't as much I was hoping for. CF I also got out of. Remember, I was already complaining about this one because we've been going nowhere. Absolutely nowhere. It was dropping below yesterday's open as well, and I'm just like, I wanted to lighten up anyway. I was looking for excuses to lighten up, and that was an easy one just to bail on that one. Again, if it starts moving again, we can get back in it. But again, the good news is it didn't lose me any money, but it didn't make me much money either. So it was just kind of a waste of time there. And then, so what am I in right now? And what am I planning on getting out of? I still have natural gas trade. A little bit of a bearish candle today. We're getting into resistance here, but it was still up, and now tomorrow maybe it makes a move down ahead of that meeting, and I go ahead and get out. But I kind of want to hold something through the meeting in case it really starts taking off, that I can catch it. MPC, now this again could be one to get out of too, but this looks a little bit more corrective to me than those other ones were big sharp down moves. This looks like a little choppy right through here, so this could be a correction for a move higher. I might hang on to that one, but I am going to get out of. I think I'm going to exit tech. And you say, well, why? It's the only one that's up clearly today. You are bumping into a little bit of resistance here. We're at the extreme right side of that reversal risk. And again, I'm trying to find some excuses to go to cash, because I think we're like I said, my opinion is over this next week we could start to see a bigger drop. I can always jump back in. Remember, the whole purpose, I should be mostly in cash. The whole purpose of these classes for the last few months has been to see if we can grind out some profits while we're dealing with this bear market. But I'm going to go ahead and exit this one. And it's right at $38 right now. So $676 profit. All right. Now, again, I might add something here. In fact, let me go over what I'm going to add. I'm going to add, and I'm probably a day. I should have done this earlier, but I liked. Hold on just a second here. Try to remember the gold stock. Newmont, NEM. Now, this is where I got to be careful to add, but strength rank is pretty low, and you're going to see a strength rank very low on a lot of these. So from a traditional software standpoint, you probably wouldn't want to be doing too many of these trades. You want to look for higher strength rank stocks, but again, you can see the big. Let's go to back out. Let's see a longer term chart. big drop, and then it's been basing right through here. And if you draw a trend line right across the top of this, it broke out yesterday. I did an option trade on this, so I caught this move today, this little gap up, but it's the candle's looking a little bit weaker, but I'm looking at this as a longer term trade. I'm going to get in. I'm going to put my stop down below here. And let's just close our eyes and hold this one for a while, because I think because when gold goes on a run, it can take off. Now, remember what I said earlier, there's a price level on gold. I'll try to do the research on this for Tuesday's class, where they start making big profits. They really start becoming profitable. I don't think it's there yet, but if it gets to that point, that's where you could probably see this thing really, really take off. So anyway, that's one I'm going to add. And if the market sells off, that's the thing. I'm going to put my stop down below here. If the market sells off, sometimes everything can drop when it sells off. But some of these things that have already made these huge drops usually don't have much further to drop. Not to mention that I think a drop, again, sometimes you can have those washout days where everything goes down, but I think after that, it could be a fuel for gold to go higher. Is there's more fear in the market and concern in the market and more reason to go into gold at that point. So I don't think it'll take out that November low. Well, and if it does, that's how we manage our trades. We'll put our stop down below there. What was that low? Low is $37.45. So let's put it at 37.40. $37.40, and 100 shares would be 4,000. 200 shares, right at 9,000. Let's see what my risk is. My portfolio risk, I don't like that to be above 1.5%. It's at 1.62. And what this is telling me is if I do get stopped down, I'm going to lose 2,246 or 1.62% of my entire portfolio. I want that below. So there's two ways I can deal with this. Either I can buy fewer shares or I can move my stop up. I don't want to move my stop up. So let's go with 150 shares. How does that look? Yeah, we're down below 1.5%. And actually the dollar amount is more in line too with what I'd be comfortable with. So I'm going to keep it at that. And let's go ahead and purchase. Now, I might add in, let's see how this one looks. Let's look at, I want to add in an inverse ETF, but I want to be careful here because there's still, this is looking at the inverse of the chip stock, so the SMH. So we look at the SMH, this is the chip sector. This still looks like it could, it's got that pause day, but remember we were talking about this with the NASDAQ 100 and the Russell 2000 that it just could break out a little bit right here. Yeah, I don't think, I'm going to hold off. Here's what I'm going to do. But I'll address it here in class. If we do, let's say we have that jobs report, the market starts selling off, I'm going to probably get into either one of these, either the SOXS, the other one I use is the SARK, which is the opposite of the ARK Innovation Fund, the ARKK, which is a basket of kind of small cap stocks that have really got beaten up lately. but I usually get into both of these, one or both of these, when the market starts selling off. If I think it's going to be a bigger sell-off, I'll start adding more of these inverse ETFs. We'll try to really profit from that drop if we do drop. But it's too indecisive today for me to want to, because this could go against us. If we have a big rally, these things drop pretty dramatically too, and I don't want to have it drop that portfolio down. So I'm going to wait on these. But if we do start selling off tomorrow, then you can be sure I'm either adding one or two of these. If it's really looking ugly, you can bet that I'm adding both of them. If the market's up tomorrow, I'm not doing anything. And now if it starts dropping on Monday, then I might be adding as well. Anytime it looks like the market is selling off or starting to drop, I'll probably be adding these in to hedge and to make money. There's not a lot to hedge right now. I only have 3 positions. Mostly in cash, but I could make money on the drop, and that would be an objective at that point as well. All right, now I do want to go over some trades, even though again I'm going to add the warning of what I just talked about for the last hour, the risk of reversal here. But if you go into the new buys, there are a few that I like, and a lot of these you're seeing in a similar sector. So this is a sector that you might want to start paying attention to, which is the biotech sector. We're starting to see a lot of these show up. Medical, biotech. This is in the medical drug sector, CTIC. Again, a little bit of a cup with handle type formation right here. Now you could wait for the breakout, and probably should wait for the breakout in this condition here. But if this can break out above here, the rule of thumb on a cup with handle pattern is you take the distance from the top of the cup to the bottom of the cup, you project that upward. Doesn't mean it always gets there. Doesn't mean it gets there immediately. But it happens enough times to where we call it a rule of thumb, but this area just so happens to line up with this previous high right here. So that would be a pretty good target area if we break out. And I like that one. Let me switch this on to signals here too. Another one in that group, muscle stocks here, is VRNA right here, another biotech medical stock, another cup with handle formation. Here's your large cup, large handle. Got your it's right at the breakout area. Tried to break out today. Did wait for it to break out, but there again, you can take the distance from the top of the cup to the bottom of the cup, project it upward. If it does break out, it'll tend to move towards that area. Very thinly traded stock, not much volume to it, so there's a little bit of risk there to factor in. Wouldn't want to have a large position, something like that. And then the last one is this IMCR, another bio type stock. Trending upward, and this looks like a little bit of a correction within the uptrend. Again, as long as it maintains those higher highs, higher lows. This is dipped back to a hold signal, so you could wait for maybe a little bit more confirmation. But it's also been going up, this whole time during a market decline. It's been going up pretty steadily over the last 6 months. So it's kind of been outperforming a little bit. And then, I'd probably wait to see what the OPEC news is, but you go into the oil sector, and I like this PDS. Nice little upward move right here. And looks like a little bit of a ABC correction right here. Could it start catapulting higher if oil's going higher. By the way, there's a lot of oil stocks. If you pull up an oil stock and it's all the way down here, don't jump into those stocks. it's easy to it's easy to talk yourself into it because you're like, man, it's all the way down here. It was all the way up here. If it goes all the way back up there, I'm going to make a killing. But so many oil stocks have taken off during this last run. Why has that stock not participated? That's the big, a lot of these, let me show you an example. As I was looking at this as I was going through some of these oil stocks, it'd be easy just to pick any one of these. And you could pick this one right here, HUSA, and say, oh man, let's go to 1 year chart here. You can see it. Oh, look, it spiked all the way up into here. Oil takes off again. It could do it. Oil's been trending up and it's been going nowhere. Why? And it's a $4 stock. Oh, so don't buy it just because it's cheap and you can afford to buy it because you don't have a big account. Ask yourself, why is it not participating? As you look at a stock like Devon, and although a lot of the oil markets have been kind of sideways lately, but you look at Devon and it's at least been, it's not too far off those highs right there. And it was just recently there, just a little bit ago. It really went on a run right through here. Why are you messing around with a stock that you have to ask yourself, is there something wrong? The management team suck. They have a huge amount of debt. And, if they didn't rally during that period of time, they might be one step away from bankruptcy if there's a downturn in the oil market. So you just want to be really careful. Don't buy something just because it's down. And again, it has a high strength rank, but don't buy it just because it has a high strength rank. If it's been down, like I said, in comparison to the other stocks in the sector, it's just been underperforming. And then one last one here, this Tidewater TDW. Again, it had a nice run through here. This looks like a pullback, a choppy pullback. If oil takes off again, this should take off with it. Like I said, wait for that Sunday meeting. I still think, even if it makes a big move right off of it, I still think it will continue to trend up, and you could at least participate in it, because some of these could drop down big, and I don't want anyone to take a big loss. All right, that's all I have. Have a great weekend, and we'll see you next week for the Tuesday for the market update class. Bye, everyone.